When you need money fast, whether it's for an emergency, a big purchase, or to pay off debt, you usually have two main options: a personal loan or a credit card loan. Both can give you access to funds, both come with their own benefits, and both have risks that can seriously impact your financial future if you're not careful. A personal loan is a lump sum of money that you borrow from a bank, credit union, or online lender. You get the money up front, and then you pay it back in fixed monthly installments over a set period, usually 2 to 7 years. The interest rate you get depends on your credit score, income, and other factors. If you got good credit, you might score a rate as low as 6 or 7%. But if your credit isn't great, the rate can be much higher, sometimes 20% or more. The best part of a personal loan is predictability. You know exactly how much you owe every month and when you'll be debt-free. That structure can be really helpful, especially if you're paying off something like high-interest credit card debt or covering a big, one-time expense like a wedding or medical bill. Credit card loans, on the other hand, work differently. When you borrow against your credit card limit, it usually happens in one of two ways. You either carry a balance, spending on your card and not paying it all off, so the remaining balance rolls over with interest, or you take a cash advance, withdrawing money from your card and repaying it with interest and fees on top. Unlike a personal loan, credit cards don't have fixed terms. Repayment is flexible. You can pay the minimum, pay in full, or anything in between. But the trade-off is that interest rates on credit cards are usually much higher. The average today is around 20 to 25%. So credit cards give you flexibility and instant access to funds. But that flexibility can be dangerous if you're not disciplined. Personal loans have several advantages. They often come with lower interest rates compared to credit cards, especially if you qualify with good credit. They have fixed payments, so you know exactly what you owe each month, and a clear payoff timeline, so you can circle the date when you'll be debt-free. You can also borrow larger amounts, ranging from a few thousand to $50,000 or more. Imagine this. You have $10,000 in credit card debt at 22% interest. You might be paying hundreds every month just in interest. But if you roll that into a personal loan at 9%, suddenly more of your money goes toward the principal, and you can pay off the debt much faster. But personal loans aren't perfect. They require good credit to qualify for the best rates. They aren't flexible because once you take the loan, you're locked into monthly payments no matter what. Some lenders also charge origination fees, prepayment penalties, or late fees. And there's the temptation to overspend. If you use a personal loan to pay off credit cards but don't change your habits, you could end up with two sets of debt instead of one. Credit card loans, on the other hand, offer their own set of advantages. They provide instant access to money. You don't need to apply for a new loan if you already have a card. They're flexible, letting you decide how much to pay each month. Many cards come with rewards, perks, or cashback, and some offer promotional 0% interest for 12 to 18 months, which could be an excellent way to borrow money short-term with no interest at all if you can pay it back before the promotion ends. For example, if you need to cover a $2,000 car repair, putting on a card with 0% APR for 12 months could give you time to spread out the payments without paying interest at all. But the downsides are serious. Regular interest rates on credit cards are high, often double or triple what you'd pay with a personal loan. Paying only the minimum can trap you in debt for decades. Cash advances usually come with extra fees and even higher rates than purchases. And unlike a personal loan, there's no end date. You carry the debt until you decide to pay it off. So which option should you choose? The answer depends on your situation. If you need a large amount of money, want lower interest, and prefer structured payments, a personal loan may be the better choice. If you only need a small amount, can pay it off quickly, or qualify for a 0% APR card, then a credit card loan might be smarter. A simple rule of thumb is this. If you can pay off the debt within a year and qualify for 0% APR, use a credit card. If it's going to take longer, or you need more structure, go with a personal loan. At the end of the day, neither option is bad on its own. It all comes down to how you use it. A personal loan can be a powerful tool for consolidating debt and lowering interest. A credit card loan can be convenient and even free with the right offer. But both can also be dangerous if you borrow more than you can handle. The key is discipline. Borrow wisely, pay on time, and always have a repayment plan before you take on debt. Ask yourself, do I want flexibility or do I want structure? Do I need a short-term bridge or a long-term repayment plan? Answering those questions honestly will help you choose the option that works best for you. Which one do you think fits your situation best? Share your thoughts. And remember, the right choice today could save you thousands tomorrow.